Welcome to the deep dive, our mission. Well, it's to cut through the noise and give you the essential insights, a true shortcut to being genuinely well informed. Today's deep dive is really custom tailored for you, the curious learner, and it's brought to you by Stock Analytics AI. For just €4.99 a month, our members get priority deep dives on specific tickers. Over the next few months, we're covering all of the S&P 500 stocks, and members get that exclusive priority access. And, if you just want a one-off deep dive, you can always drop a super thanks. Okay, let's unpack this. We're plunging into the world of Archer-Daniels-Midland, ticker symbol ADM. This is a company that, well, it forms the invisible backbone of the global food system. As of our analysis date, that's June 28, 2025, ADM's share price sits at $51.97. Now, here's the hook. Our educational intrinsic value range suggests it should probably be trading between, say, $55 and $65 per share, yet the market is clearly pricing in substantial risk. Analysts are largely saying hold or reduce. So what does this pretty significant disconnect mean for you? Is ADM truly poised to thrive by feeding the future, or has its immense scale actually become a vulnerability in today's rapidly changing world? Let's find out. Every great company has a story, right? And ADM's begins with its colossal footprint in global agriculture. But like any giant, its strengths can sometimes be its Achilles heel. Let's peel back the layers. We'll start with exactly what they do, then we'll look at the leaders trying to steer this massive ship, and finally, we'll crunch the numbers that paint their financial picture. Hashtag check chapter 1, business understanding. Okay, so to truly grasp ADM's position, we have to start with its core. What exactly is this company that touches so much of our daily lives?
Well, at its heart, ADM is a 123-year-old global agricultural supply chain manager and processor. It really is a pillar of the global food system. They connect local harvest to global demand, operating hundreds of plants and facilities all over the world.
Right, and their business model boils down to three main things.
Exactly. Three massive interconnected gears. First, they originate procuring raw agricultural commodities from thousands of farmers globally. Then there's logistics. They use this incredible integrated network, grain elevators, trucks, rail, barges, vessels for storage and transport. And finally, they process those raw materials into products for food, animal feed, fuel, and various industrial sectors. It's a huge operation.
Okay, and how does that break down in terms of revenue? What are the main segments?
Good question. The largest is ag services and oilseeds, that handling everything from getting the raw materials like sourcing and transport to crushing oilseeds like soybeans and canola. So think vegetable oils, salad oils, cooking oils, even biodiesel, and also protein meals for animal feed. That's the big traditional piece.
Got it. What else?
Then there's carbohydrate solutions. This segment converts corn and wheat through milling processes. The outputs there are things like sweeteners, high fructose corn syrup is a big one, starches, flour, and also bioproducts like ethanol and industrial alcohol.
Okay, and the third segment, you mentioned it's a key strategic area.
Yes, nutrition. This is their higher growth, higher margin segment. It's where they create value-added ingredients and solutions. We're talking plant-based proteins for meat and dairy alternatives, natural flavors and colors, probiotics for gut health, even specialized pet food ingredients. It's much more tailored.
So their overall message is about unlocking the power of nature.
That's their stated value proposition. Unlock the power of nature to enrich the quality of life. In practice, yeah, it means food security, sustainable practices, and innovation for, evolving global needs.
What's fascinating here is how ADM's sheer scale allows them to operate on razor-thin margins in commodity trading. But this isn't just old school farming anymore, is it?
Not at all. Their strategic pivot to nutrition really reflects broader industry shifts. We're seeing huge adoption of technology and precision agriculture.
Yeah.
Think AI, IoT, data analytics to optimize yields, reduce waste.
Right. And sustainability seems huge, too.
Absolutely. Sustainability and regenerative agriculture are becoming major drivers. Restoring soil health, biodiversity, carbon sequestration. It's pushed by regulation and consumer demand. There's also the significant push for bio-based solutions, replacing petroleum-based products with plant-derived alternatives like bioplastics. That's a big potential area.
And nutrition ties into that consumer demand.
Precisely. Functional foods and nutrition is a major trend. Consumers are actively seeking specific health benefits, immune support, cognitive health, gut health from their food. It's exactly why ADM is betting so heavily on its nutrition segment.
Makes sense. But they're not alone in this space, are they? What's the competition like?
Oh, it's intensely fierce, dominated by a few giants. You've got privately held Cargill, which is massive, and then public competitors like Bunge Global, BG, Ingredion, INGR, and Tyson Foods, TSN.
And how does ADM stack up against them, say, financially?
Well, if you look at a quick snapshot, ADM has a market cap around $25.5 billion. a PE ratio of about 18.6, and a dividend yield near 3.8%. Their net margin is quite low, though, around 1.6%.
How does that PE compare?
That's the interesting part. Its PE of 18.6 is notably higher than Bunge Global's, which is around 10.9, even though Bunge actually has a better net profit margin.
So the market's giving ADM a bit of a premium, maybe for that nutrition potential.
That's likely part of it. It implies the market is willing to pay more for ADM's future potential, despite current performance. Competition here isn't just about size anymore, it's increasingly about innovation.
Okay. And what about barriers? Is it easy for someone new to challenge ADM?
Not at all. The regulatory environment alone is incredibly complex. Food safety, environmental rules, things like the U.S. Renewable Volume Obligations for biofuels, which directly impacts their ethanol business. But the real barrier is the sheer capital investment required. Imagine trying to replicate ADM's global network of processing plants, storage facilities, ports, transport infrastructure. It's virtually impossible.
Plus the relationships and expertise, I imagine.
Exactly. Deep relationships with farmers and customers, decades of logistics know-how, sophisticated risk management expertise. These create very high barriers to entry.
So what are their core competitive advantages then?
Several key ones. Strong brand strength, especially B2B, where reliability and global reach matter hugely. Their most significant advantage is probably cost advantages, economies of scale, crucial for profitability on thin commodity margins. Then there are powerful network effects. Their vast origination and processing network makes them the efficient buyer and preferred supplier. Switching costs for major customers can be quite high.
And their assets themselves.
Yes, they're unique assets that integrated global value chain is hard to beat. And increasingly, they're developing proprietary ingredients and patents in the nutrition segment, adding another layer.
That scale is truly staggering. But managing all that, especially with thin commodity margins, how do they handle the internal risks? And what about recent headlines? Who's steering this ship? Hashtag chapter 2, management evaluation. All right, let's talk leadership. Who's at the helm and how are they doing?
The CEO is Juan R. Luciano. He's been in charge since January 2015, came over from Dow Chemical. His tenure has largely been defined by that strategic transformation we mentioned, really pushing the pivot from traditional commodities towards the higher growth, higher margin nutrition segment, trying to make ADM less cyclical, more of a sophisticated ingredient provider.
Okay, sounds positive. But there have been some issues recently, haven't there?
Yes, quite significant ones. In early 2025, news broke that ADM is under investigation by both the SEC and the Department of Justice. It concerns accounting practices, specifically within that very nutrition segment they're pinning their hopes on.
Oof. How serious is that?
Management has acknowledged a material weakness in internal controls over financial reporting for that segment. Think of it like this. If a company's financial reporting is a house, a material weakness means there are serious cracks in the foundation. It raises significant risk that the numbers they report might not be accurate or reliable.
That definitely hits investor trust.
Hugely. And it creates this really troubling contradiction. ADM has been named one of the world's most ethical companies by Ethisphere for 4 years running. They emphasize integrity.
Yet they have an accounting scandal.
Exactly. It's damaging and could easily create a persistent credibility discount on the stock price. How do you reconcile those two things?
Are there other concerns too?
Yeah, adding to the pressure, there was a recent cattle feed recall and news of at least one law firm actively encouraging shareholder litigation over the accounting issues. It's a difficult period for management's reputation.
Okay, so credibility is a major issue right now. How are they managing the company's money? Let's talk capital allocation.
They describe their approach as disciplined and balanced. They generally favor smaller, strategic bolt-on acquisitions rather than huge, transformative deals. The focus is clearly on building out nutrition and biosolutions, those high-margin ingredients, and also expanding in emerging markets.
Have any recent examples?
Yeah, sure. In late 2023 and early 2024, they acquired Revilla Foods, which does dairy flavoring, and FDL, a functional ingredient producer. Both were aimed at broadening their global flavors capabilities within that nutrition segment.
What about returning capital to shareholders? Buybacks, dividends?
Yes, both are key parts of their strategy. They have a long-standing share repurchase program. It was just extended another 5 years through the end of 2029 and upsized to 300 million shares back in December 2024.
And the dividend, they're famous for that, right?
Absolutely. Their dividend policy is a cornerstone. ADM is an S&P 500 dividend aristocrat. That's a very exclusive club. It means they've consistently raised their dividend for 53 consecutive years, and they've paid dividends uninterrupted for over 93 years. That's incredible consistency.
Wow. What kind of increases are we talking?
They target a payout ratio of 30–40% of earnings. Looking at recent history, the annual dividend grew consistently. For 2024, it was $2 per share, which was an 11.11% increase from the year before.
That sounds very shareholder friendly, but you mentioned a red flag earlier.
Yes, and this is critical for you as an investor to weigh. While the company is buying back shares and raising dividends, we see a very different pattern with insider transactions. Over the past year, top executives, including the CEO, have consistently sold shares on the open market. There have been no significant insider purchases.
So public optimism via buybacks and dividends, but private actions look more cautious.
Precisely. It's a divergence that warrants serious attention. Why are the insiders selling if the prospects are so bright?
Okay, one more metric on management performance. Return on invested capital. How are they doing there?
Right, ROIC. For the trailing 4 quarters ending Q1 2025, ADM's adjusted ROIC was 7.0%.
And how does it stack up?
Well, it's below the company's own target of 10% ROIC. And maybe more importantly, it's also below its estimated weighted average cost of capital, or WACC, which is around 7.8%.
So they're investing capital, but the return isn't covering the cost of that capital.
On average, yes, that's what it suggests. It implies recent investments haven't generated sufficient returns, potentially destroying shareholder value rather than creating it. It questions the effectiveness of that strategic deployment.
Okay, we've looked at the business and the people. Now let's dive into the financial health and performance. What do the raw numbers tell us? Hashtag tag chapter 3, financial analysis. All right, let's get into the numbers, starting with the basics. Market cap. Where does ADM stand?
As of June 28, 2025, their market capitalization was approximately $25.01 billion.
That sounds big, but how does it compare historically?
Well, it's actually a significant decline from its peak in 2022 when it was over $51 billion. So, yeah, the market has definitely reacted to some of the concerns we've discussed.
Understood. What about revenue growth trends over, say, the last 5 years?
It really shows the cyclical nature of their core business. There was a strong surge from 2020 to 2022, driven by the commodity boom. But then revenue declined down 7.5% in 2023 and another 9.0% in 2024.
And more recently?
For the trailing 12 months ending March 34, 2025, revenue was $83.86 billion. That's an 8.6% decline year over year. It really underscores how much commodity cycles still influence their results, even with that pivot towards nutrition.
Okay, revenue is down. What about profit margins? Are they making more or less on each sale?
Margins are definitely feeling the squeeze. For the trailing 12 months ending Q1 2025, margins were frankly quite thin. Gross profit margin was 6.32%, operating margin was way down at 1.85%, and net margin was just 1.63%.
Wow, that's tight. Was Q1 particularly bad?
Yes, Q1 2025 was rough. Total segment operating profit plunged 38% compared to the previous year, and net earnings fell a steep 57% year over year. It really highlights severe margin compression across the business.
Okay, so profits are under pressure. What about actual cash generation, free cash flow?
Yes. Free cash flow is really revealing for ADM because it's been incredibly volatile. Looking at the last 5 years, it swung from negative $3.21 billion in 2020 to a positive $5.43 billion in 2021 during the boom, and then settled back to $1.23 billion positive in 2024.
Why such big swings?
It's largely tied to commodity prices and working capital. When prices shoot up, they need a lot more cash tied up in inventory. When prices fall, cash gets released. This volatility exposes a hidden risk, right? In tight credit markets, managing those large cash swings could become challenging. Liquidity could be tested.
Okay. Despite the volatility, how consistent have their earnings been over the longer term?
Well, earnings per share, EPS, have certainly been cyclical over the last decade, mirroring those commodity swings. There was a big drop from the 2022 peak, for instance. But importantly, they've remained profitable even during very tough times. During the Great Recession, their EPS actually increased in both 2008 and 2009.
That does prove how essential their business is, doesn't it?
It really does. People still need to eat, regardless of the economy.
What about their balance sheet? How leveraged are they? Let's look at the debt-to-equity ratio.
As of Q1 2025, it was 0.34. That's generally considered conservative and healthy. They're not dangerously reliant on debt.
And their ability to cover short-term bills, the current ratio.
Also looks solid. As of March 31st, 2025, it was 1.38. That indicates a good capacity to meet their short-term obligations.
And we already touched on dividend stability and growth, which is clearly a strong point.
Absolutely. That dividend aristocrat status, 93 plus years paid, 53 consecutive increases is a major pillar of stability, and the 5-year dividend growth rate is a healthy 7.4%.
So mixing all this together, the revenue pressure, thin margins, volatile cash flow, but also the essential nature, solid balance sheet, and great dividend record. What does this mean for valuation? Is the stock cheap or expensive?
That's the million-dollar question, isn't it? Let's look at relative valuation first, using the PE ratio. As of late June 2025, the trailing 12-month PE was around 18.9.
How does that compare historically and to peers?
Well, it's actually higher than its 10-year historical average PE, which is closer to 14.6. And as we mentioned, it's higher than key peers like Bunge, around 10.2, and Ingredient, around 14.0.
Wait, so the PE is high even though earnings have been falling. How does that work?
It's a disconnect. Earnings fell faster than the stock price, which mathematically pushed the PE ratio up. The market seems to believe these depressed earnings are temporary. But for a value investor, paying a higher than average PE during a period of declining earnings, that definitely calls for caution.
Okay, that's relative value. What about trying to estimate its intrinsic value? Maybe using a discounted cash flow model.
Right, a DCF analysis. The basic idea, for you listening, is to estimate all the future cash a company is expected to generate and then discount that back to its present value, because money today is worth more than money tomorrow, the time value of money.
So you project future cash flows and apply a discount rate.
Exactly. The formula essentially sums up each future year's cash flow, CF, divided by 1 plus the discount rate R raised to the power of the year, number N. DCF, CF1, 1 plus R, plus CFN, 1 plus RN, plus a terminal value.
And what does an illustrative DCF suggest for ADM?
Based on our educational model, using some reasonable but illustrative assumptions, we get an estimated intrinsic value range for ADM of $55 to $65 per share.
Okay, $55 to $65. What are the key assumptions behind that range?
Two main ones. We use the discount rate, or WOCC, weighted average cost of capital, of 7.5%. This reflects the blended cost of their debt and equity financing and falls within typical calculated ranges. And for the perpetual growth rate, the rate we assume cash flows grow forever after the initial forecast period, we used a conservative 2.5%. This reflects a mature business but allows for some long-term growth from nutrition and biosolutions.
And of course, small changes in those assumptions can significantly change the result, right?
Yeah, absolutely. DCF is very sensitive to assumptions. This is purely illustrative for educational purposes.
Okay, we've dissected the business itself and the financials. Now let's shift our lens to how the market perceives ADM, who actually owns the company, and the landscape of risks it faces. Hashtag chapter 4, market sentiment. So how does Wall Street actually feel about ADM right now, given everything we've discussed?
Well, if you look at analyst price targets and consensus rating, the sentiment is pretty lukewarm, maybe even leaning negative. The consensus rating among the analysts covering the stock is generally reduce or hold, majority recommending either hold or even sell. Very few buys right now.
And what about their price targets? Where do they see the stock going?
The average 12-month price target seems to be in the range of about $49 to $52. The full range reported is wider, maybe $44 up to 66 cents. But with the current price around $51.97, that average target suggests analysts see quite limited near-term upside potential.
Are opinions changing much? Any recent upgrades or downgrades?
Opinions are definitely divided. For example, UBS Group recently upgraded the stock to buy, but almost concurrently, Bank of America downgraded it to underperform.
Oh.
So yeah, conflicting views out there.
What about the general news flow and media tone? Is it positive or negative?
It's really a bifurcated narrative, quite split. If you look at company press releases, they're naturally positive. They highlight things like being named one of America's greatest workplaces in manufacturing 2025, winning innovation awards, declaring dividends. It paints a picture of a steady, forward-looking company.
But the financial news?
The financial press tends to focus much more on the negative side and the risks. Headlines are dominated by that sharp earnings plunge we talked about, profit warnings linked to geopolitical tariffs, the ongoing accounting investigation, that product recall.
So it's like the company trying to manage perception versus the market focusing on tangible risks.
Exactly. It shows that tug of war for the narrative. Are they the ethical innovator or a troubled giant facing headwinds?
Interesting. What about other market indicators like short interest? Are many people betting against the stock?
Short interest is currently around 2.3% of the float. That's the percentage of shares available for trading that have been sold short. It's not exceptionally high, certainly not signaling a massive bearish attack, but it does indicate a non-trivial level of negative sentiment. It's perhaps slightly below the average for its peer group.
Okay. And technically, how is the stock price doing relative to its trends? the moving averages.
This is where that disconnect we mentioned earlier shows up. The current price of $51.97 is actually above its 50-day moving average, which was around $49.47. That's usually seen as a short-term bullish signal. And it's also above its 200-day moving average of $48.73, which is typically interpreted as a longer-term bullish signal.
So the price chart looks strong, but the fundamentals and analyst views are cautious.
Precisely. The technical strength, the upward momentum in the price, doesn't seem fully supported by the declining profits or the cautious analyst sentiment. It suggests recent price rallies might be more influenced by broader market movements than by specific positive developments at ADM itself.
That's a stark contrast. So with all these different signals swirling around, who actually owned ADM? And what does their activity tell us about their confidence or lack thereof? Hashtag tag tag chapter 5, ownership structure. Let's look at who holds the shares. What's the institutional ownership like?
It's very high. Somewhere between 82% and 85% of ADM shares are held by institutions like mutual funds, pension funds, ETFs. This is pretty typical for a large established company that's part of major stock indices.
Who are the biggest holders?
The top names are the usual suspects. Vanguard holds about 12.5%. State Farm Insurance is surprisingly large at 9.74%. BlackRock has around 9.34%. State Street is up there too. A lot of these are passive index tracking funds. They hold ADM because it's in the index, not necessarily because they're making an active bet on the company's success.
Okay, so institutions own most of it. What about insider holdings, the people running the company?
That's where the picture gets quite different. Insider ownership is actually very low, only around 1%.
Only 1%. That seems low for executives.
It is relatively low. And this ties into the major concern we flagged earlier, the pattern of recent insider transactions. Over the past year, the activity has been overwhelmingly one-sided, consistent selling by top executives, including the CEO. There have been no significant open market purchases by insiders during that time.
So it's like a tale of two cities, passive institutions holding steady, while active, informed insiders are consistently selling.
That's a good way to put it. For investors who follow the principle that insiders know their company best, like Warren Buffett, often emphasizes this consistent selling pattern is a significant red flag regarding management's confidence and alignment with shareholders.
Given the high institutional ownership, is the ownership concentrated? Does that pose any risks?
Yes, ownership concentration is quite high. The top 10 institutional investors control over 55% of the company's shares. The top 25 own over 65%.
What's the impact of that concentration?
It means that the buy or sell decisions of just a few large fund managers can have an outsized impact on the stock price and its liquidity. If one or two major holders decide to reduce their position or exit entirely, it could put significant downward pressure on the share price.
Right, so high passive ownership provides some stability, but concentration risk is there, and the insider selling is definitely a point of concern for you to watch.
Okay, we've analyzed the good, the bad, the numerical, the market view, and the ownership. Now let's try to map out the specific risks and opportunities ahead for ADM using a classic framework. Hashtag tag chapter 6, risk assessment. Let's break ADM down using a SWOT analysis. Strengths, weaknesses, opportunities, threats, starting with the internal positives. Strengths. Okay. ADM's biggest strength is undoubtedly its unmatched global asset network. That physical infrastructure, the plants, silos, ports, transportation, is an incredibly high barrier to entry, almost insurmountable. Tied to that are significant economies of scale, giving them crucial cost advantages, especially vital in the low-margin commodity side of the business. They also have a diversified business model. Operating across ag services, carbohydrates, and nutrition helps buffer them against weakness in any single segment or market.
And the dividend record.
Definitely strength. That dividend aristocrat status, over 50 consecutive years of increases, signals incredible financial resilience and a strong commitment to returning capital to shareholders.
All right, now the internal negatives, weaknesses.
The most obvious one is their low and volatile profit margins, particularly in the core segments. They're highly sensitive to commodity prices, energy costs, shipping rates, things often outside their direct control. A major weakness right now is the damaged management credibility stemming from that ongoing accounting investigation. It casts doubt on financial reporting integrity and creates uncertainty. And related to the margin issue is their inherently cyclical earnings profile. Results can swing dramatically based on the commodity cycle, making performance difficult to predict consistently.
Okay, moving outside the company, what are the future opportunities?
A biggest strategic opportunity is clearly growth in nutrition, tapping into the higher margin health and wellness market, functional foods, plant-based alternatives. That's the key growth engine they're trying to build. There's also significant potential in bio-based industrial solutions using agricultural feedstocks to replace petroleum-based products like plastics, solvents, and other industrial materials. That's a long-term secular trend.
Any other?
Yes, carbon markets and sustainability. As regenerative agriculture practices grow, ADM is positioned to potentially benefit, perhaps even monetize, carbon credits generated on farms they work with, turning sustainability from just a cost center into a potential revenue stream.
Now for the external challenges. Threats. What are the general ones?
Well, intense global competition is a constant. They're always battling giants like Cargill and Bunge, which puts relentless pressure on margins. Commodity price volatility is an inherent threat. Unpredictable swings in the prices of corn, soy, wheat can dramatically impact profitability, both up and down. And of course, weather and climate change. Extreme weather events, changing growing seasons, these can disrupt supply chains, impact crop yields globally, and create huge operational challenges.
What about broader economic factors, macroeconomic threats?
Two big ones right now are inflation and interest rates. Inflation increases their operating costs, fuel, energy, labor, which really squeezes those already thin margins. Higher interest rates make borrowing more expensive, which is significant for a capital-intensive business like ADM that needs funding for inventory, global operations, and new investments. Higher rates mean higher interest expense on debt.
And finally, the big one these days, geopolitical factors. How vulnerable is ADM?
Hugely vulnerable. Their entire business model is built on the relatively free flow of agricultural goods across borders. So things like tariffs and trade disputes are a direct threat. We don't even need hypotheticals. Remember that 52% plunge in ag services and oilseeds profit in Q1 2025. Management directly cited trade policy uncertainty as a key factor.
So any new broader tariffs, say hypothetical ones imposed in 2025, would hit them hard.
Absolutely. It would disrupt global trade flows, likely reduce demand for U.S. exports, force costly rerouting of shipments, and put severe pressure on profitability. In a way, the very global network that is ADM the greatest strength becomes its biggest vulnerability in a world that seems to be moving towards more protectionism and trade friction.
Wow, okay, that lays out the landscape pretty clearly. Strengths and opportunities, but significant weaknesses and looming threats. We've journeyed through the intricate world of ADM, from its core business to the market's view and the risks ahead. So let's try to synthesize all these findings and tie it together. What's the bottom line? #tag Chapter 7. Conclusion. Let's try to summarize the opposing arguments. First, the bull case for ADM. Why might someone be optimistic?
Well, the foundation is that it's an essential business. It's truly indispensable to the global food system. That provides a certain baseline resilience. They possess a formidable economic moat built on that irreplaceable global asset network and economies of scale. It's incredibly difficult to compete with them directly. They are very shareholder-friendly, highlighted by that dividend aristocrat status and consistent share buybacks. That appeals to income and long-term investors. And strategically, that pivot to nutrition and biosolutions offers a clear path towards potentially less cyclical, higher quality, higher margin growth in the future. That's the transformation story.
Okay, that's the bull case. Now, the bear case. Why the caution?
The immediate concern is severe margin pressure. Profits in their core ag services and oilseeds segment are collapsing right now. That's a major drag. There are major geopolitical headwinds. The business is highly vulnerable to tariffs, trade wars, and general global friction, as we just discussed. The management credibility issues are a serious concern. The accounting investigation, the material weakness disclosure, coupled with that heavy insider selling it, raises significant questions. And finally, despite the strategic pivot, the results are still deeply tied to the volatile commodity cycle. They haven't fully escaped that inherent cyclicality yet.
So it really comes down to a fundamental question, doesn't it?
Exactly. This raises an important question for you listening. Is ADM a resilient giant facing temporary surmountable problems which might make today's lower price a long-term opportunity? Or is its formidable moat being fundamentally eroded by a confluence of modern challenges, geopolitical shifts, credibility issues, margin pressures that it may not be able to easily overcome?
And our valuation work gives some context there.
Right. Just to restate, our educational DCF model, using those assumptions like 2.5% perpetual growth and a 7.5% WACC, suggested an intrinsic value range of $55 to $65 per share. But again, that's illustrative and highly sensitive to the inputs and the outlook actually playing out.
So, the concluding outlook.
It's really a neutral summary, leaning cautious perhaps. The current price, around $51.97, is below that estimated intrinsic value range. If you believe management can successfully navigate the current headwinds, fully resolve the accounting issues, and restore credibility, and execute successfully on that strategic pivot. However, the market is clearly pricing in substantial risk right now. The margin compression is real, the geopolitical risks are significant, and the credibility questions linger. Ultimately, the decision for you as an investor hinges on that crucial judgment call. Are these temporary problems for a fundamentally strong company? Or are we seeing a more fundamental erosion of its long-term competitive advantages?
That was a truly deep dive into Archer-Daniels-Midland. We've certainly uncovered layers from its foundational business and financial health to market sentiment, ownership dynamics, and those really significant risks it faces. The tension between its essential role in feeding the world and its current, very real challenges definitely gives you a lot to consider. And here's a provocative thought to leave you with. Think about how the very global integration that has historically given ADM its immense strength could also become its greatest vulnerability in a world that seems increasingly drawn towards protectionism and nationalism. How might a company built on connecting global harvest to global demand adapt to a future where borders, tariffs, and trade disputes matter more than ever? Something to chew on. That's all for this deep dive. Don't forget to like and subscribe to the Stock Analytics AI YouTube channel. Members, remember you can add stock suggestions for future videos right there in the comments, and we do prioritize those for our deep dives. And if you just want a one-off deep dive on a specific company, remember you can always drop us a super thanks. We appreciate the support.
And just a reminder, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thank you for joining us on the deep dive. We hope this has given you that shortcut to being truly well informed. See you next time.